Something which may surprise you is that active funds consistently underperform, consistently fall behind their benchmark passive index. In fact, a study found that a whopping 99% of US actively managed equity funds couldn't beat the S&P 500 over a period in the 2000s. This tells us that trying to pick the market often doesn't work. History suggests it's a gamble that doesn't usually pay off, and it's a common culprit for unsuccessful investing. But this video is not about bursting bubbles. It's all about how to be successful investing, and specifically how to be successful on fund-focused platforms such as Vanguard and InvestEngine. These platforms are titans of the fund investing world and cater to a specific type of investing. To be successful with this type of investing, there are some common secrets, and in this video we're going to cover 4 of the biggest. So stick around as we unravel these secrets. If you're new to the channel, I'm Alex, a management consultant by day, and on this channel we discuss all things finance with particular focus on how to grow your money. And if you haven't already, I'd really appreciate a subscribe, as this will help me grow my channel and produce more videos. So let's get into it with the first secret for success on fund-focused platforms. And there's no better place to start than with a secret we've already unraveled, already uncovered, and that's choosing passive funds. Funds can be either active, in which a fund manager actively manages a set of assets, buying and selling to try and beat the market, or they can be passive, where typically a fund tracks an index and aims to follow market returns. And nowadays, most passive funds come in the form of ETFs and are traded on exchanges. The big benefit of active funds is that they attempt to beat the general market returns. However, as we found at the start of the video, very few active funds actually do this. And the study we used at the start of the video not only found that most active funds in the US failed to beat the US general market in the S&P 500, but that study also found that only 2 in every 100 global equity funds outperformed the S&P Global 1200 index over the period 2006 to 2016. However, it's also worth noting that the organisation who produced this study in Dow Jones S&P are slightly biased in using their own passive indices to compare performance in a time range where passive indices did very well. But they still do paint a picture which is valid, in that very few active funds outperform the market. Some of you may be doubting this though. You may have seen headlines of specific active funds which have had remarkable returns above and beyond passive indices. And sure, a few active funds do well each year. However, they often fail to be consistently good and fail to beat passive indices over a long period of time. And the reason for this is because active funds are effectively gambling, and the odds of winning are often not in their favour in the long run. By this, I mean that active fund managers focus on particular stocks and build a portfolio of these stocks, and they're effectively placing bets that these particular stocks will outperform the general market. And just like you or me doing a bet, for example, a football accumulator, this may work once, and this is great, but it doesn't work consistently time and time again because so many factors are at play. I at least have never had 2 or 3 football accumulators come in a row. I've never had that. And there's a reason for that. There's a reason for the odds you get with a football accumulator, as that's the likelihood of the return based on the information from the bookmaker. And a theory has been built along these same lines for stock market valuations. It's called efficient market hypothesis, and it states that share prices reflect all information and that stocks trade at a fair market value, which effectively means that it's very difficult to beat the market consistently because stocks are always reflective of their true market value. So they're never really undervalued. Funds are never really undervalued, so how can you try and beat them? And supporters of this theory suggest that investors will benefit most from investing in passive funds. So I think it's quite clear that there's a lot of research out there which suggests that passive funds tend to beat active funds in terms of performance over the long run. However, this can still be debated, as some people may point out specific studies or specific active funds which have done well and beat passive funds over a long period. So there's still some debate in this argument. However, there isn't any debate with another benefit of passive funds over active funds, and that's the fact that passive funds are often cheaper than active funds. And there's a clear reason for this, as with active funds, you have a fund manager who's picking stocks, who's buying and selling, and this requires a fee. The fund manager needs to be paid, so it often comes with higher costs. Whereas with a passive fund, you don't have a fund manager actively picking stocks and buying and selling, so there's a lower management fee for this reason. And that's a big benefit of passive funds over the long run, as those fees can take off a lot of performance. So for all of these reasons, it's typically better to choose a passive fund or an ETF tracking a passive index than an active fund in order to be successful in the long term on platforms such as InvestEngine and Vanguard. And thankfully, these platforms have a huge range of low cost passive funds available. So that's the first secret for success. The second secret for success is diversification. And you may be thinking, with platforms like InvestEngine and Vanguard, they offer funds, and funds are naturally diversified because they have many assets within them. However, not every fund is a juggernaut of diversification. You can have funds which are industry specific, such as a robotics fund, which just focuses on the robotics sector. Or you can have funds which are country specific, such as the FTSE 100, which just focuses on the UK stock market. It's often better to take that diversification to the next level with a globally diversified portfolio. As with this, your returns aren't dependent on one specific asset, one specific country, one specific sector. And the reason why this is beneficial and it's typically better is because you reduce risk with a globally diversified portfolio and you smooth out your returns. Think of it this way: buying a single country fund or a single industry fund is like backing the star player of a football team. However, buying a globally diversified fund is like backing the whole squad. If the star player doesn't perform, if one player doesn't perform, it doesn't matter because you've got others to pick up the slack. And that's the beauty of globally diversified funds. You have other stocks in there, you have other countries, you have other industries to pick up the slack whilst other industries, whilst other countries don't do so well. And in order to achieve a globally diversified portfolio, there's three main areas to look at, three main areas you need diversification across. Firstly, country. Secondly, company size, with small size companies, medium sized companies and large size companies. You need all of them to be diversified. And thirdly, across sectors. And if you want to be diversified outside the stock market too, then adding other asset classes will also help your diversification. But the three main factors I just went through are specific to diversification in the stock market. And you can achieve this globally diversified portfolio very easily with Vanguard and InvestEngine funds. There's funds out there such as Vanguard's Global All Cap, which covers those three areas I just spoke about. And you can add in a precious metals ETF, precious metals fund, if you want to add that asset class diversification as well. So that's the second secret for success on fund-focused platforms, having a globally diversified portfolio. The third secret for success is time in the market, having a long-term view for investing. Many investors have a short-term view with investing in buying investments, then selling them a few months later in order to try and chase higher returns. However, no one knows exactly how share prices will behave, how markets will behave, and this means that trying to time the market could just end up being painful. You may sell at a low point, or you may buy at a high point. And markets are typically very volatile in the short term, which increases your chance of losing money if you're buying and selling with a short-term view. It's often just better to hold on to your investments in the long term for a time frame above 5 years, as this typically gives you enough time to ride out any bumps in the market and make a positive return. For example, if we take a look at a graph of the S&P 500, the returns over the last 20 years, we can see that in some years the S&P 500 went down significantly. Imagine if you were a short-term investor and invested in an S&P 500 tracking fund in 2008 or 2002 when the market went down more than 20% and then needed the money a few months later and withdrew. It would not be a good experience. You would have lost money. However, if we zoom out on this graph and look at any 5-year period, the overall growth over any 5-year period tends to be positive with the S&P 500. And this shows the benefits of holding onto your investment for the long term above 5 years, as it gives your investments long enough to ride out any bumps in the market. And another big benefit of long-term investing compared to short-term investing is that you get to exploit the compound effect. For example, let's bring up a compound interest calculator to put this theory into practice. And let's say that we have an initial investment amount of £10,000. And let's say that the annual investment growth is 8% every year. And let's start off to see how much the investment would be worth after 3 years. So after 3 years, the investment is worth just over £12,500. But now let's say you left the money there for 10 years, you're a longer term investor. And in this case, the value of your money after 10 years would be over £21,500, so nearly £10,000 more than leaving it there for 3 years. And this shows the power of the compound effect. You need to leave your money invested for a longer period to exploit the compound effect. The longer you leave it, the more time it has to work and to grow. So time is a key secret for success on fund-focused platforms. So now we have one secret left, and the fourth and final secret for success on fund-focused platforms is consistency in making regular payments into your investment funds over a long period of time. And a well-known approach for this, the best-known approach for this, is dollar cost averaging or pound cost averaging for the folks like me in the UK. And this is where you invest a set sum of money over a regular period of time. For example, most people, including myself, do this by investing a set amount of our monthly paycheck into our investments. I do this through InvestEngine, and InvestEngine make this super simple through automation features where a set sum is taken from my bank account, it's placed and transferred to InvestEngine, and then it's automatically invested in my set funds. So this is really simple for me to be consistent. And by spreading my investment payments out at every single month, it ensures that I get an average market price rather than trying to time the market and putting a lump sum all at once and risking getting the market high point. So I get an average market price with this approach too. And the power of being consistent, adding to your portfolio slowly but surely over time, can be seen with the compound interest calculator. If we go back to that and see what would happen if I add another £5,000 every single year over that 10-year period, we can see that that 21.5k jumps to 94k. So it's a huge impact by being consistent, consistently adding to my portfolio. And now if we extend the period to 20 years, we can see that that 94k has gone up to over 275k. So just by being consistent and adding 5k every year, my portfolio has grown significantly, it's grown exponentially. So this calculation makes the benefits of being consistent over a long period of time super clear. And this finishes off the 4 secrets to being successful on fund-focused platforms. Firstly, in investing in passive funds. Secondly, in having a globally diversified portfolio of funds. Thirdly, in giving your investments enough time to make a good return. And lastly, in being consistent. If you want to put these secrets into practice with InvestEngine, then I have a walkthrough review, a walkthrough tutorial of investing on InvestEngine somewhere around here. If you click around here, you should be able to access that video. But for this video, thanks guys.